Donald Trump has started a major conflict with Iran. Oil prices are rising. Global trade routes are under pressure. And yet, the S&P 500 is still holding up. No massive crash, no panic selling. But this raises a very important question, because historically, wars in the Middle East often trigger massive shocks in the global economy. So why isn't the stock market collapsing this time? To understand this, we need to look at oil, inflation, AI, and spending. Because once you connect all these pieces together, you start to see a completely different picture. The first thing investors worried about was oil. Iran controls one of the most important shipping routes, the Strait of Hormuz. About 20% of global oil supply passes through this narrow waterway. If that route is disrupted, the energy market reacts. Less supply. Same demand. And according to basic economics, that means higher prices. Some analysts see oil hitting $150. Higher oil prices lead to higher transportation, manufacturing, and electricity costs, and eventually higher prices everywhere. In other words, inflation. And inflation is usually bad for the stock market because it forces central banks to keep rates high. But the market isn't falling. Why? The answer starts here. The United States is now the largest oil producer in the world. That was not the case in the 1970s. Back then, America was heavily dependent on Middle Eastern oil. Today is different. Thanks to the shale revolution, the United States produces enormous amounts of oil domestically. Our vulnerability is reduced. Most of the oil the U.S. imports comes from Canada. Canadian oil is heavier, which makes it perfect for our refineries. Investors know this. Even if Middle Eastern supply is disrupted, the United States is far less vulnerable than it used to be. Another reason is expectations. Investors are betting that the conflict will be relatively short. This reduces panic selling. Historically, markets react based on duration. If it's weeks instead of years, investors stay invested to avoid locking in losses. Now here's a surprise. War can stimulate economic activity because governments dramatically increase spending on defense and tech. That spending flows directly into businesses. Higher revenue leads to higher profits, which supports stock valuations. It's not because the situation is good. It's because massive government spending enters the economy, providing a floor. Then there's inflation. When prices rise, cash loses purchasing power. Investors look for assets that can protect wealth. Many choose stocks of strong companies. These businesses can raise prices to maintain profits even if inflation goes up. So instead of selling during inflation, many investors prefer staying invested. It's about protecting their long-term wealth. Investors have also become used to surprises. Tariffs, trade wars, threats, we've seen them all. Most eventually soften. Because of that history, investors today are more cautious about overreacting. They wait to see how events actually unfold. But perhaps the biggest reason the market remains strong is something else entirely: artificial intelligence. We are currently in the middle of what many analysts call the AI revolution. Think about the biggest companies in the world today: Apple, Microsoft, Google, Nvidia, Amazon. These companies dominate the stock market. Investors don't want to miss the next technological revolution, because many people who miss the internet boom regret it today, and nobody wants to make the same mistake with AI. However, there is one important risk. Technology companies often rely on future growth. Their valuations depend on profits expected many years from now. But when interest rates rise, future profits become less valuable today. So the real story is more complex than it appears. The market hasn't crashed because investors see several balancing forces: energy superpower status, short war bets, government spending, and AI optimism. But markets can change quickly, and if oil prices spike or the conflict escalates further, the situation could look very different. For investors, every crisis also creates opportunities.